let's not waste time and start the session. I think I don't have to introduce Ashvin, but there are few clients who have joined here for the first time. So for their benefit, let me have the privilege of introducing Ashvin. So Ashvin brings about more than 11 years of experience on the table. And before joining Marcellus, he used to work for Ambit Capital as a portfolio manager. And he was also an analyst and used to cover a lot of aspect on the forensic research. And he continued the same thing. And also he is now handling couple of portfolios, and one of the portfolios that he is looking at is Little Champ as well. So today's agenda is to discuss about Marcellus Little Champ. I remember last time when it was opened up for a very brief time, and it got oversubscribed. And then Marcellus decided to close the screen because of the fact that it has limitations in terms of accommodating both number of investors and the overall volume. So we'll try and understand today why it is going ahead and what is the reason of opening up again. How this portfolio is positioned, and how it is different from other portfolios, especially Rising Giant. So we are not wasting even single minute out here, and requesting Ashwin to please take over from here.
Sure. Thanks, Vikas. Thanks for the introduction. So let me share my presentation. Yeah. So we are used to doing Zoom and Teams. So, so apologies if I am I hope this presentation is visible. Is the slide visible?
Yeah, it's coming up.
Okay. So let me know.
Yeah, so it's coming up as of now, not visible. Yeah, it has come up now.
Okay.
I hope audience are also able to see the screen.
Yeah, do just let me know in case.
Ashwin, I hope you got the context that what was the reason of stopping. Yeah. Over to you.
Okay. Thank you. So we'll focus on the Little Champ strategy of Marcellus today, and so
it is visible.
Okay. Thanks. So we'll focus on the Marcellus Little Champ strategy in this today's session.
So basically, this is the slide which summarizes the whole objective of Little Champ's portfolio. So on the top right hand side chart, you will find that there is a blue dotted line that is nothing but the BSE 500. And what we observed that we did an analysis of the market from June 2003 to June 2020. What we observed is that the companies which are on the way to entering the BSE 500, which are essentially the companies on the left hand side of that blue dotted line, they deliver spectacular returns, right? And you actually can see that in the chart. Whereas once the companies typically enter the BSE 500, next 2-3 साल उनके लिए काफी muted रहता है. So I'll come to the reasons. But primarily focus of the Little Champs is to find these set of companies, which are neither too small that, BSE 500 is a long way for them to enter. But at the same time, they are meaningfully sized key. They are say like 1 to 3 years away from entering the BSE 500. And the companies typically of these companies typically, have a market cap somewhere around say, $300, $400, $500 million. Typically, ये market size ka companies fall in this set of companies, which are eventually maybe in next 3-4 years will be part of the BSE 500. So if I had to summarize the whole objective of Little Champs, that is nothing but finding these potential entrants to BSE 500. So identify these companies which are potential going to be part of the BSE 500, which is the top 500 listed companies in India. Invest that at this point in time, and basically make a lot of money, which you can actually see on the screen. And also what we found is that typically these companies, small companies, they are not owned in any meaningful way by large institutional investors. So typically mutual funds, large institutional investors like mutual funds, they invest in companies which are sizable. For them, for example, less than $1 billion companies doesn't move the needle for them. because mutual funds typically, when you talk about any good mutual funds, typically 50,000 ka equity AUM hoga. For them, investing in these small companies wouldn't move the needle for them. As a result, they stay away from these small companies. At the same time, because mutual funds don't invest in these companies, there is no incentive for sell side analyst, for research analyst to write research on these companies. Right, because even if I write a very good piece of research on these companies, but if my client is not going to act on this, not buy shares, there is no commission to be made, right? So there is no incentive for sell side analysts to write research on these companies. So basically, there is a lot of opportunity because these institutional investors, analysts don't write about these stocks. If you look at the bottom right hand side chart, you'll find that small cap companies, they trade at a fraction of what the mid cap and large cap companies traded, despite having similar, more or less similar fundamentals as these mid and large cap companies. Because these are not known, they are not owned by institutional investors. Nobody largely knows about these companies. So as a result, the valuation these companies, small cap companies command, they are at significant discount compared to mid and large caps, large cap names. Moving on. But at the same time, while I talked about the opportunities and money to be made in the small cap space, but at the same time, small cap investing is not easy, right? So if you look at the right hand side couple of charts, you'll find that while it is you can make a lot of money by investing in identifying good quality small caps, but if you actually end up investing in wrong quality of small caps, there is an absolute wealth destruction or carnage of the wealth that you can see. And unfortunately, in India, I would say ki, the set of small caps where money to be made is relatively less compared to the set of small cap companies where there is a chances of losing money. And that primarily happens because of 2 to 3 reasons, very peculiar to the small cap space. One is that the level of corporate governance is relatively weak in small companies. And this happens because small caps are largely run by one person. The level of institutionalization or the institutional oversight of that person is weak because promoters run the show, right? And there is typically no professional management team. There is no strong independent board of directors. So as a result, the level of scrutiny within the organization is very less. Hence, the promoter gets a free way to kind of do all sort of things with the accounts. So that is one. Secondly, the business model of small caps is also typically, they may be dependent on one large customers or typically one product or one market. So concentration risk काफी ज़्यादा होता है small cap space में. So that is also another reason. And third is the liquidity reason, because small cap liquidity is during bear market, there is no buyer for small caps because everybody folks to the large company, go back to the large company. So as a result, despite very good fundamentals, you will find that typically small cap bear market में कितना भी अच्छा small cap हो fundamentally, you will see a correction. And the reverse is the case during the bull market, where the demand is very high, but supply is very short. As a result, the price actually goes up significantly. So there will be volatility in small caps, primarily coming because of lack of liquidity. So that is a third challenge. And what we have done here at Marcellus is to keep these things keep in mind the pitfalls of investing in small caps, these 3 things which I mentioned about, and hence construct our investment process in such a way that we minimize the risk of investing in wrong quality small caps. So अगर आप risk कम कर पाओगे, I think we will end up making very good absolute return in the space. So first focusing on filtering out the poor quality small caps, then on a short list, basically identify which are the great franchises to own. So the investment philosophy of Little Champs is no different from what we have for other products in Marcellus. Essentially 3 attributes. First and foremost, and which is very relevant for small cap, is clean company. Corporate governance should be clean. So that is the starting point. Second attribute, look for dominant franchises. So we don't want to invest in 7th, 8th largest player in a large sector. Even though the sector is large, opportunity is high, but seventh, eighth largest player means that the pricing power is very weak. And pricing power weak hoga, so you will not make margin, you will not make return on capital employed. So no matter how big the sector is, we don't want to invest in the weaker players within the sector. But at the same time, even if the sector is small, but if there is a dominant player, you like to invest in that company because that company is dominant. It means that it is cannot be wished away by the customer. The pricing power is very high. The ROC is very high. So we look for dominant franchises, even though it may be a niche or a small segment, small sector. And third, we look for companies with great capital allocation. So companies should neither be too lethargic that the cash of the core business is getting piled on the balance sheet. At the same time, the company should not be too aggressive that they are investing in all kind of unrelated businesses. We want companies which are reinvesting very smartly. Either reinvest it back into the core business to gain more market share, or where you have reached a very high level of market share already in your core business, why not develop adjacencies? Adjacencies. For example, we own a company called Crore Technical Fibers in Little Champs. So Crore, until say 20 years back, it was dominant in Indian fishing net markets. But over the last 10-15 years, it has built a very strong franchise in global salmon aquaculture cage market, where the product is more or less similar. So the base, polymers, etc. is all similar. Obviously, there is a differentiation in terms of additives to be used, etc. But essentially, Crore is using its core polymer engineering expertise to expand into new segments. So in a way, it is different, but at the same time, it is related also to the core businesses. So we like this kind of capital allocation, where the new segment is actually drawing upon the strength of your franchise, basically. So it is not unrelated in a sense. Or you basically going for expansion of the distribution network. If a company is already strong in say one state, why not go pan India level? And if the company is already strong at the pan India level, why not target the global market, right? So we have many such examples in Little Champs. But basically, essentially, the new growth drivers has to draw upon the strength of the existing core franchises, where the chances of success is relatively higher, this kind of capital allocation. So we look at that kind of capital allocation. So clean company, dominant company, very good capital allocator. And to find companies with such three attributes, it sounds very simple, but there are very few companies actually which are able to clear these three basic attributes. And I will explain that through our investment process. So this is our investment process. Most of you must have seen that the chart or the flow looks similar to what we have for other products. So essentially, there is a starting universe. So there are roughly 1,000 companies which are listed in less than $500 million market cap. So the first filter which we use is the forensic accounting screen. So forensic accounting screen is nothing but a set of 12 accounting ratios which we use to weed out companies with low accounting quality, because ultimately your analysis is all based on the numbers reported by the company. So the first step that you need to do is to convince yourself that the numbers जो company बता रहा है, that is actually true and represents a true and fair view of the state of affairs. So that is first stage. So to convince ourselves about the sanctity of the reported numbers, we pass these 1,000 companies through 12 accounting ratios. Some of the examples are given on this slide. For example, I personally believe the first ratio which is mentioned is the most important. कि आपका profit कितना cash में convert हो रहा है. Because what we have understood basis our experience of the last 12 to 13 years of reading the financial statements, most of the fraud happens on the P&L statement because it is very easy. For example, आपको अगर profit ज़्यादा बताना है तो you have to basically do aggressive revenue recognition. Either it could be a transaction which is fake, मतलब fake revenue account करो, or basically inflate the revenues. So उसपे क्या होगा कि basically your P&L will look very strong. P&L will present a rosy picture. Profit अच्छा दिखेगा. But when you look at the balance sheet and the cash flow statement of that company, it will tell you a completely different story. Balance sheet में इतना profit करने के बावजूद balance sheet में debt will keep on piling up. You'll wonder why why the company has to take on debt even though it is reporting good profit. The problem is that because these are not genuine profit, बैलेंस शीट में द ट्रेड रिसीवेबल विल कीप ऑन ब्लोटिंग अप, and to finance that trade receivable, the company has to take on debt. In other words, there is no cash which is getting generated in the organization, and this ratio punishes companies where the operating cash is very low when you compare to the level of operating profit. So that is one example. We have such other 11 ratios, total 12 ratios, which we pass this 1,000 companies to this battery of 12 ratios. The score is computed for each and every company. We rank them on decile basis, D1 being the best 10%, D10 being the worst 10%, and we eliminate the bottom 40%. Because our framework is telling कि इस पे आप 40% के numbers पे आप rely नहीं कर सकते हो, and we follow what our model is saying. So 40% of the companies get flushed out at the forensic accounting screen. Now there are roughly 600, 500, 600 companies which are there, जिसपे numbers पे हमको we have a conviction that numbers are numbers जो दिखा रहे हैं वो true and fair view है. Now our object is to find market leading franchises, good capital allocators. To find those companies, again, we use 6 years financials. We use 5 ratios. What is the growth in the revenue over the last 6 years? Then what is the improvement in the gross margin? Because operating margin, typically small caps में operating margin, because these are sub-scale companies, operating margin may be a little bit unreasonable for these companies. So look at the gross margin. Unit economics at least अच्छा है क्या? Because कल को company scale up करेगा, the unit economics is good, it will translate to strong operating margin. So we look at improvement in gross margin over the last 6 years. What is the improvement in working capital days? What is the improvement in fixed assets turnover? And finally, is your unit gross margin able to cover your interest expenses? So it is kind of an interest coverage. So we use these 5 ratios, rank these 600 companies basis किसका कितना improvement है. We give them percentile rank on each ratios, and we select companies which score more than 50% on each and every ratio. For example, if the company scores good on revenue growth but it's weak on working capital days, that company wouldn't get selected. And you'll be surprised to know that these 5 ratios sound very simple, but 600 में से only 40-45 companies or max 50 companies in any year actually they are able to clear these simple thresholds. And these 40-45 companies form the basis for our bottom-up research. We do extensive due diligence on these companies, reading 15-20 years of annual report, speaking to a whole host of people in the industry, customers से लेके, competitors से लेके, employees से, ex-employees. We don't typically speak to current employees because we don't want to get into the insider information. Obviously, management से बात करते हैं, but not to the employees. Ex-employees से बात करते हैं, vendors से बात करते हैं. And it takes, it's a very time-consuming process in small and mid-cap because these companies are not very well-known in the industry. So to at least speak to 10 people, it takes, I would say, 6 months से लेके 1 साल minimum लग जाता है. But we think it is worth the amount of time investing, worth the effort investing. Because small caps में, when you meet two people, you get to know a lot about them. Because these companies, again, published में भी इनका ज़्यादा information ये लोग disclose नहीं करते. So when you meet people in the industry, आपको पूरा, you get to know a whole host of new insights on the company. So ये सब करके then we decide up through our longevity framework. So I'll not go into the depth of it, but longevity framework is nothing but कितना growth runway है company में, industry का saturation level कितना है, market share gain opportunity कितना है, capital allocation, new growth drivers से कितना revenue growth आ सकता है, and secondly what is the longevity, company कितना साल ये deliver कर सकता है. So that is dependent on mode score, lethargy score, and succession planning, etc. So basis this combination of these two things, we decide which is the best 15, 16, not more than 20 companies that should make it to the actual portfolio. And basis that we have, I will come to the returns part, but basis that, we have kind of then build the retail sales portfolio. So unfortunately, there is one column which is missing here. So FY 16 to 21 May, at the portfolio level, these companies would have delivered weighted average 21% earnings growth. Whereas for the BSE small cap index, the earnings growth over FY 16 to 21, I would suggest would not have been more than 6-7%. So it has grown nearly thrice the time of the typical small caps in a very tough environment. FY 16 to 21 has been one of the challenging, demon, GST, COVID भी आ गया फिर last में. So in a tough environment, these companies have been able to deliver this earnings growth. That has primarily come from two reasons. One is the market share gains, because I will come to specifically COVID ka, but every crisis में these companies actually benefit. नियर टर्म में इनको इम्पैक्ट होता है, बट स्ट्रक्चरली बिकॉज इनका बैलेंस शीट इतना स्ट्रांग होता है. फॉर एग्जांपल, लुक एट द नेट डेट इक्विटी कॉलम. यू विल फाइंड दैट द फिगर इज इन ब्रैकेट, व्हिच मींस दैट दे हैव एक्चुअली कैश इन देयर बैलेंस शीट. Whereas look at the typical BSE small cap में 1 के आसपास डेट इक्विटी रहता है. इनफैक्ट दिस इज द एवरेज नंबर. There will be whole host of companies which will be having 1.5 to 3x. So crisis में वो companies survive नहीं कर पाते हैं. Whereas these companies, because they have strong balance sheet, they are able to absorb that hit of the crisis and they are able to gain market share. And second is basically the capital allocation. These companies keep on finding new avenues of growth. So, and that has contributed significantly to their earnings growth. So FY 16 to 21, 21% earnings growth compared to 7-8% for the broader small cap space. And look at the ROC differential. ROC for these companies in FY 21 was 24%, whereas BSE small cap actually pass bhi nahi hai. So that is on the fundamentals. And quickly covering in, the fundamental performance is only accelerated through the COVID crisis. So look at the PBT column, which is the 1, 2, 3, 4, 5. Sixth column here, you will find in 9 months FY22, the PBT at the weighted average level has actually accelerated to 27%. जो 20-21% ये companies deliver करते थे pre-COVID, that has actually accelerated to 27%. So COVID, as I said, like crisis actually is beneficial for this company. So इनका earnings fundamental growth has actually has accelerated through the COVID. And if you look at the revenue growth column, that will show a completely different ज़्यादा ही उधर acceleration हुआ है. So the fundamentals of these companies have accelerated, and that is because through COVID, these companies have actually stepped up their investments. So look at most of the companies over here. GMM Pfaudler has made 4 acquisitions in the last 2 years. So pehle, for example, these companies, whatever amount these companies used to reinvest in, say, a period of 5 years, last 2 साल में they are finding so much opportunity. जो पहले 5 साल में invest करते थे, now they are investing in 2 years actually. So that is the kind of opportunity these companies are seeing. And across all the companies in the remarks column, you'll find that last 2 years these companies have taken a lot of action. For example, Suprajit recently announced the acquisitions of a large company, cable company in Europe. So that will make Suprajit one of the largest cable manufacturers in the world. Similarly, Moltech is actually expanding into new segments. So basically, through COVID, these companies are finding opportunities left, right, and center. And to some extent, the 9-month FY22 numbers, which you see, the acceleration that has come up because of these actions. But we think more of this we will be able to see over the next 3 to 5 years. Because इसका अभी काफी मतलब for example सुप्रीजित का जो acquisition है इसका benefit तो अभी आगे चल के आएगा. So far it is not. Similarly, GMM Pfaudler, which acquired its parent, I think most of the synergies will flow through in the next 3 to 5 years. So we remain very sanguine about the prospects of this company, irrespective of the macro. तो macro अगर strong recovery आ गया तो I think it will help. But even if the macro remains muted, there is a lot of opportunities within their sectors for these companies to keep on compounding their earnings growth. And hence, we remain very sanguine about the prospects of these companies. And fundamentally speaking, we think these are possibly best positioned. As they have been in the last 5-6 years, they are very best positioned from a competitive perspective, these companies. Having said that, there are a couple of challenges, in near-term challenges that these companies are facing. For example, in third quarter FY22 column, PBT column, you will find that some of the numbers are in red, which means there is a decline in the earnings. There are 2 near-term challenges. One is commodity price inflation, which I think all of you know that commodity across the board, whether it is steel or basic chemicals or crude-based derivatives, they have seen a sharp rise over the last 1 year. And उसमें क्या होता है कि these companies, they have the pricing power, but there is a lag in passing off because there is a quarter or 1 or 2 quarter lag in passing off to the customers. So as a result, third quarter has been little bit not very great for few of the companies. And second is basically the supply chain issues. For example, Galaxy, it's seeing very strong demand for its surfactant. But the problem is the palm oil comes from Malaysia, and Malaysia was under COVID lockdown. Now the things are improving, but 3 months back there is palm oil ka shortage tha. Similarly, there is some intermediaries that come from China for some of these companies. For example, Alcala Mines supplies to pharma, where pharma has a lot of dependency on China. for some intermediates. तो उसका shortage था. So pharma production, while alkyl didn't have any raw material problem, but its customers, pharma companies, were having shortage of some raw materials from China. So as a result, alkyl का volume भी थोड़ा suffer हो गया. So there are supply chain issues. Having said that, supply chain issue is easing out. I think semiconductor also taking time. It will not normalize soon, but at least every month we are seeing positive development on supply chain issues. So I think supply chain is also very transient. And just to tell you about why we are not bothered about inflation is that these companies have historically demonstrated very strong pricing power. And primarily because of 2 to 3 things. One is that these companies are market leaders. As I talked about, these are dominant companies. तो कस्टमर अगर इनको प्राइस हाइक नहीं देगा तो कहाँ जाएगा, where they get the sourcing from. So customer has no choice. In fact, most of the companies have inbuilt agreements with their customers. So एकदम raw material is always a pass through in most of the B2B industries. Some expenses like power and fuel are not pass throughs, but these companies, they are champions of efficiencies. So power and fuel बढ़ गया तो they actually draw a lot on their internal efficiencies और वो mitigate कर देते हैं. So dominance is the first point. Secondly, fortunately for us, most of the Little Champs companies, 50-55% of the Little Champs companies, they cater to industry which are very resilient. For example, pharma में जाता है, personal care industry में जाता है, food industry में जाता है, where the demand is relatively inelastic. So customer price देना ही पड़ता है, मतलब because these products are essentials of the life. So you don't have 50% of the Little Champs exposure is to that kind of end user industries. And finally, as I said, like जैसे COVID has been a boon for these companies in terms of market share gain. We think these near-term challenges surrounding supply chain, surrounding inflation, it is actually structurally positive for these companies because peers, who operate on wafer thin margin, 4-5% का margin बनाते हैं, उनके लिए inflation, they will turn into losses. Whereas these companies have double-digit margin, they are able to absorb that near-term inflation hit ले सकते हैं. उसके बावजूद they will be able to generate positive cash flow. Because उनका margin इतना strong है. Whereas peers, they operate on low single digit margin, they will be generating losses, उधर cash drain होगा. So balance sheet gap will only strengthen through this crisis for these companies. And hence we think structurally 1 or 2 quarters numbers will get impacted, but structurally 3 to 5 year perspective में these crises actually are advantages to these companies. So that was on the fundamental side. I will come to the return part because I think most of you will be interested in return. So return side में, since inception, the portfolio has delivered 34.1%. Look at the last bar, which is in line within what we have intended. In fact, it's slightly better than what we generally guide for around 25 to 30% return for the Little Champs portfolio. Primarily because earnings compounding of say 20-25% for these companies and a kicker of 5 percentage points because of the valuation re-rating. जो starting का मैंने slide बताया, these companies as they become more and more visible, they will command a better valuation. But earnings has to be the primary driver. So this is how we are looking at the return for these companies. Since inception, it has gone as per our expectation. Last 2 years returns have been very good from an absolute perspective because we are talking from COVID ka bottom se, COVID first wave ka bottom se, and last 1 year also healthy despite third quarter February and March have not been very great for especially February May the portfolio is down 7%. Despite that last 1 year ka return seen that 21% hai. Now some of you will have a question about the underperformance in the last 1 year and 2 year. That is primarily because last 1 year, 2 year is largely bull market. And our portfolios typically, they don't outperform in the bull market. Because bull market may, I'll show you the stocks which outperform in the bull market. So when you look at the last 1 year, BSE small cap may, which are the best performing. So these are till 17th March. Best performing stocks, when you look at this right hand side ka table, BSE small cap may सबसे best performing stocks. When you look at the names, you'll figure that most of these companies are either real estate companies, या infrastructure companies, या commodity company, या power energy companies. So typically these companies bull market में वो companies चलते हैं जो bull market के पहले सबसे ज़्यादा fall हुए थे basically. So I'm sure, pretty sure that prior to this commencement of the bull market, these companies would have fallen say 18, 19 and first quarter of FY20, these companies would have fallen by 50, 60, 70%. and from that low base, these companies have bounced back. So if you restrict your analysis to only the bull market, you'll find that these companies must have delivered very spectacular return. But when you expand your period to even include the 18, 19, 20 period, I would say that Little Champs companies would have handsomely outperformed these companies, because Little Champs companies, they exhibit very high degree of resilience during weak
Sure.
markets. So that is on the return side. And why we opened Little Champs again? Because
Yeah, so that was a question. So we have 3 minutes to go,
okay.
and we'll conclude the session at exactly
Because you have any
1 hour.
specific
So
question, I'll happy to
maybe
answer
you
that.
tell us how much you can accommodate more. Yeah.
Okay. So should I answer that? Why we opened it?
Yeah. Please,
So
please.
primarily because one, we this is a limited capacity product. So and we were very worried कि इसमें हम लोग ज़्यादा पैसा नहीं लेंगे, because because one is the number of stocks are limited quality wise, and secondly we didn't want to take big position in these companies, because suppose we have to exit from these companies. If you have a very big position, suppose we own 5-6% of market cap, we have to necessarily crush the prices, because these are illiquid. So as a result, that was the thought process. July 2020, may we stopped taking money in this fund, because at that point in time, these companies were trading at very low volumes. Their average traded volumes were very low. But what has happened in the last 2 years, because of the market being conducive, and but more importantly, because these companies have become more visible, and because these companies also become bigger, the ADV of these companies has seen significant increase in the last 2 years. जो पहले for example 1 crore का daily value traded होता था, that has now increased to 3-4 crores. So as a result, and our capacity is determined on the average daily value traded. For example, we don't invest more than 20 days of ADV in any company. एक position लेते हैं तो 20 days of average daily value traded से ज़्यादा नहीं लेते. So because these volumes have increased significantly, now we have more capacity in the product. So that is one reason ADV has increased of most of these stocks. Secondly, which was not by design, but some of the stocks we have exited. For example, the note is there in the bottom: Music Broadcast, PPAP, Sterling Tool, and Lumax. These companies which we have exited, and we have replaced it with companies like Tarson's. Then there is one new stocks which we have, stock 16, which you can see. We have not named it yet. We'll disclose it in our newsletter. Then we have got Avas in the last 12 months, which are more liquid than the stocks which we have exited. So as a result, that has also increased the space in the fund. So that is all. Having said that, we will not keep it open forever. It will still be a limited time period. Maybe 150 crores, or we will take more in this product, and we will stop again in this product. Over to you, Vikas. I'm not able to hear you, Vikas.
No, so I'm saying just wanted to thank you for joining the call today. We have a limited time now.
Sorry, actually, I think this because of this technical reason we wasted some time. But happy to. If there are any follow-up questions, do write to us through Vikas.
Yeah,
we'll be happy to answer that.
Sure. So, dear participants, if you have any questions, please write to me at vikas@aifpms.com, and I'll get them answered. So, thank you so much, all of you, for joining the call. Thank you, Ashvin.
Thank you, everybody. Thank you. Take care.